Well, we can't tell just yet if we have turned the corner in this fairly mixed market. So let's bring in Keith Springer. He is president of Springer Financial Advisors. Keith, good to have you with us today. I mean, I was feeling like a bit of a skeptic the last 3 days, I have to admit. I was feeling like it was maybe a counter-trend move in an oversold market. Where do we go from here? I mean, a lot depends on Europe, a lot depends on earnings, but what is the key headline that you are looking for?
There are two major things, Mandy. One is earnings. Earnings traditionally for the last few years have surprised on the upside. We have this sort of give and take in between earnings season, and then earnings come in and they continuously surprise. And we have so much negative investor sentiment out there, it is just dreary. Everywhere you go, people are negative, people are worried, people are almost rooting for the market to go from.
Too negative?
I'm not negative in the short term. Longer term, I'm a little bit worried. I think the structural changes and problems we have, much of what I wrote about in Facing Goliath are still there. But in the short term, I think I like the fact that people are dreary going into earnings season. I think earnings are going to be better than expected. The other thing is on Tuesday, we had a major reversal. We were down big Tuesday morning, and then we reversed strong to be on the upside. To me, that was a shakeout. That looked like a capitulation to me, and I think we're going to rally pretty strong through earnings season. Again, I'm not looking for a new bull market over years and years, but I think in the short term it looks really good. Maybe for the next month, maybe 6 weeks or so through earnings, we're going to have a good period for the market.
Well, and that's fair, you know, Keith, and we talked about how we've really had a lack of big-time earnings warnings. Been some smaller companies there, but not a lot of big companies have warned. But as everybody knows, it's the guidance that matters. It is not the backward looking. So what do you expect corporate America to say about how things look ahead? Because we haven't heard a lot.
No, and again, we've got to remember that the market is emotional. It's not an analytical being. It's not a computer. If we make investors happy and feel good, they're going to buy and the market goes up. And if they get scared, they sell. And what they're looking now for is that the fact that corporate America is still in decent shape. They're doing a very good job at becoming very productive. Unfortunately, they've laid off a lot of people, but it's worked to the bottom line. So companies are going to be making decent profits. They've had emerging markets so far. They've had the ability to make money in this economy, even with high unemployment. So we're going to have that, you know, tale of two cities where we have high unemployment, we have continued bad economic news. Not terrible like you were talking about, but not great. But earnings are going to continue to be good, and this quarter's not going to be any different. And that's why I think you see the market rally pretty strong from here.
Let's bring in Peter Tuz, president of Chase Investment Counsel. Hopefully you just heard Keith saying that he feels that Q4 could surprise to the upside. What's your feeling?
Yeah, I would agree with Keith. I think there's been a lot of pessimism thrown in the market here lately, the market could surprise on the upside with better than expected earnings, accompanied with, albeit cautious guidance going forward.
Hey, Peter, this is Herb. I'm just wondering, do you think some of this guidance we could see would be lowballing to try to create a better psychology?
Yes. I mean, if you're a corporate manager these days, what is the sense in getting aggressive with your own internal projections and the projections you give to the outside world?
It's called pulling an apple. Thank you very much to Keith and Peter. Brian?
All right. One metric that many investors watch is the amount of debt on a company's books, right? And there are different reasons to take on debt. Not all bad. You know, you buy a company, you've got investments, or maybe if you can just, you know, borrow for less and less and less and less. Thank you, Ben Bernanke.